Thank you for joining me. I'm Alex, and I want to talk about Oracle today. So, what they do is mostly databases, or rather, most of their revenues from databases. They also have enterprise software. They bought Sun Microsystems, which gave them the patents to Java and a whole lot of other stuff. Current price $63, which gives them a market cap of $186 billion. Dividend yield 1.5% with a payout ratio of 29%, which is pretty decent. Means that they could go to 4.5% dividend yield without going over their whole profit. Revenue $39 billion, which is slightly down. Earnings $10.4 billion, which is slightly up, which obviously always a good thing. And current PE is 19 with a forward PE of 15, which means it's the third tech stock that I've covered recently that has a pretty decent PE, which kind of confusing to me. Total assets, $115 billion. Total liabilities, $103 billion, which gives them a total stockholders' equity of $12 billion. And that is down about half, which is kind of concerning, especially since they bought back stock for $19 billion. So all of this could have been avoided. And I don't really understand buying back stock for more than the total profit of the year. I wouldn't really know why they wouldn't go less than their earnings. I don't see the point here. Obviously, this is not sustainable because eventually they're just going to run into a negative or maybe even a hugely negative balance sheet. And with the current record highs of the stock market, I don't really see why buying back stock for $20 billion is really a good thing. Last year they bought back more stock, which is more concerning, but that's a whole different issue. So as far as the risk factors go, there really isn't much at this point. Oracle has been in business for a very long time, and obviously there have been other databases both before and after, and there's been all kinds of enterprise software. I really don't see anything disrupting a company like Oracle that kind of has weathered a lot of competitors coming and going. So I don't see any major risk factors changing in the near future. So overall, obviously, there's no growth for a growth investor. For a dividend investor, if you can deal with a dividend that is reasonably low, I think this is actually a pretty interesting stock to look into. The payout ratio is quite low. The PE is pretty nice, and you're going to have to deal with the balance sheet, I guess. So if you can't ignore the balance sheet, obviously this is not the stock for you either. For a value investor, obviously the balance sheet is definitely not great, but the PE is nice. Earnings are pretty consistent, and the whole company as a whole is pretty stable. So dividend being a nice bonus. The only thing concerning really is the balance sheet, and balance sheet kind of concerns me. Most of the problems with the balance sheet are because of stock buybacks, and obviously those kind of sort of are supposed to help value investors. So do with that what you will, I suppose. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.